You're probably seeing a lot of articles, pop-ups on Instagram, Facebook, TikTok, all these professionals trying to sell you their services, trying to create wealth for you, trying to 10x your wealth in a short amount of time. A lot of it can be true, but a lot of it, there's sort of limitations on how unrealistic borrowing power can be. Today, I want to give you a real life example on how much a couple can borrow with a certain amount of deposit and a certain amount of income. Good day everyone, I'm your host Tony Shah and thanks for joining me in another episode of The Mortgage Chat. Today I want to give you a real life example on how much a couple can borrow with a certain amount of deposit and a certain amount of income. And the reason I want to do this today is because you're probably seeing a lot of articles, pop-ups on Instagram, Facebook, TikTok, all these professionals trying to sell you their services, trying to create wealth for you, trying to 10x your wealth in a short amount of time. A lot of it can be true, but a lot of it, there's sort of limitations on how unrealistic borrowing power can be, right? My goal today is trying to show you a case study on what we've just done for one of our clients. And this case study is really good because before you sign into all these courses, these seminars from these buyer's agents or these professionals trying to sell you the bloody dream, you invest in X amount of properties, you buy X amount of properties, it grows by this much, you sell it by this much at this time, you retire with this much money, blah, 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 blah. Yes, all good and well. We all want to invest. We all want the properties to grow. We all want to sell it with a big profit. We all want to have a shitload of money in our bank account so we can retire. But really, a lot of these buyer's agents don't know the logistics on the back end, right? They don't know what the borrowing power is. They don't know the logistics of sustaining these debts. They don't know the cash flow of the clients. All they want to do is sell, 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 right? Which is, sometimes unrealistic. And all these, professionals out there trying to sell you the services, yes, maybe they are trying to do the good thing, trying to sell you good properties, right? Trying to make a lot of money for you, all right? Or trying to help you grow your wealth. But they actually don't know the logistics on the back end, how everything works, All they want to do is trying to accumulate as many properties as they can. But yes, all good and well, right? Of course I want to buy 10 properties out there tomorrow worth $500,000 each, and in 10, 15, 20 years time, they're probably worth 3-4 times the amount, right? But the main thing is, how can you sustain all that debt on the front end, right? And this is what I want to show you today for these particular couple of clients I just had. And it's a great case study for a lot of you investors or soon to be investors out there. Because my philosophy in investing is, don't rack yourself up with as much debt as you can that you can't sustain, that you can't live a good life, and you're living paycheck by paycheck, dollar by dollar, right? I'm not that. Because a lot of people don't understand the cash flow of sustaining all this debt, right? All they think about is, how much my wealth is going to grow by accumulating all these assets. They think of the positives and the future of what these properties can pretty much create for them when they retire, but they don't understand the back end of maintaining all these loans, right? And some people will go, do you know what, Tony? You're still young. You can slug it out for the first 5-10 years, pay off all these debt, sustain the debt, blah, 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 blah. But you know what? I don't want to live a shit life for the next 5-10 years, right? For example, I'm 35, right? You want me to live a shit life, living paycheck to paycheck, dollar to dollar, the next 5-10 years of my life? No, thank you, right? I'm a big believer in having a good amount of debt that is sustainable, but still can live a good life. Okay? As I just said from the beginning, I have a very good case study for a couple that's going to start the investment journey, and we just wrote out a plan for them and also a cash flow. Now, if you're only listening to this podcast, again, please go onto YouTube, just watch this particular section of the video because there's an Excel spreadsheet that's going to break a few things down for you to understand. Now, remember, this is not financial advice. This is just a guide. Okay, and the Excel spreadsheet I'm going to show you is just a guide with a few assumptions. Everyone's a bit different. Even with this plan that I wrote for the client, we are still going to rejig a few numbers around that's going to be suited for their needs. Okay, so guys, now I'm going to show you the Excel spreadsheet on the borrowing power with major lenders, second, third, and bottom of the barrel lenders. And after that, I'm going to show you the cash flow of sustaining and maintaining these debts. So everyone that's not watching this YouTube video right now, I essentially got an Excel spreadsheet in front of me where we are working out the borrowing capabilities with first, second, third, and fourth tier lenders, right? And I've got a few variables up here, and we have a few variables that we're going to use, right? So the first variable is they got $360,000 saving, which they do have. And we're going to assume the properties are going to grow enough that they can leverage off the existing properties and use that as a deposit for your subsequent investment properties after that. All right. And after the third property they're going to purchase, they're going to use equity and borrow 100% of the purchase price plus cost for the subsequent investments after that. We're going to assume they're going to buy investment properties for $500,000 each with a 6% rental yield. And we are also putting down that they are renting for $650 per week. They're rent vesting, okay? And they are both on $150,000 each with nil debts, no credit cards, no HECS, etc., etc., etc. All right, so let's break down the first box, which is we can borrow money through a major lender, okay? I don't care what you want to use it. And we have a major lender here as the first breakdown, right? So, you know, this major lender can be St. George, ANZ, Westpac, CBA Bank, West, Macquarie Bank, whatever you want to use it, okay? But we'll just use this as a basic example where they can purchase 3 investment properties at $500,000 each and borrowing $400,000, which is 80% of the loan. And why did I put 3 properties here? Well, I'm assuming that the $360,000 cash they have is enough for the 20% deposit plus stamp duty. And I'm assuming stamp duty for $500,000 property is $20,000 each because I don't know which state they're going to invest in. So we're just going to use $20,000 as an example. All right. So 20% deposit for $500,000 is $100,000 and stamp duty is $20,000. Okay, so essentially it's $120,000 for each property that you need as a deposit for a $500,000 property, which is why I put 3 properties there. So the first 3 properties they're going to buy, they're going to get an 80% loan at $400,000. Rent here, property expense here, and which I'll break it down on the cash flow later. So the first 3 properties they're going to buy, they're going to have a total loan of $1.2 million, okay, and rent here for 3 properties, property expenses for 3 properties. Now, I put on the second box here that they can buy 2 properties. And why did I segregate this? It's because I'm assuming that they're borrowing 100% of the purchase price plus cost because they're using equity from the first 3 properties as a down payment for the next 2 properties, okay? And that's why the purchase price here I got down is $500,000 and the loan here is $520,000 where they can still buy 2 properties for $500,000, borrowing 100% of the purchase price plus cost, and the total debt is going to be 1.04 mil. Essentially, they can buy 5 properties with a major lender, and this is when they are capped with the borrowing power, okay? And this is why we have to go to a second tier lender. Now, the second tier lender, I'm making an assumption here. All right, and the assumption is, where are they going to get the deposit from? Because they're already capped with the borrowing power with a major lender. All right, that's why we have to go to a second tier lender. If they're already capped here, all right, and they can't draw equity, where they're going to get the deposit from here. So for simplicity, let's just assume they can draw equity from here. All right, because I really want to show you how much money they can borrow with first, second, and third tier lenders. All right. So on the second tier lender, borrowing 100% of the purchase price plus cost, they can replicate what they did on the second box here with the major lender. All right, where they can buy another 2 properties. And subsequently, the third tier lender, they can do the same. And subsequently, with a fourth tier lender or the bottom of the barrel, let's call it, they can buy 1 more property, borrowing 100% of the purchase price plus cost. Okay, essentially now using a major, second, third, fourth tier lender or bottom of the barrel lender, they can get a total debt level of $4.84 million. All right, so which is not bad. So essentially they can buy 3, 5, 7, 9, 10 properties using pretty much 4 tiers of lenders. Okay, and this is how some people actually grow their portfolio, right? Now, I've showed you how much they can borrow, how far they can go. Now let's look at the cash flow from sustaining all these properties. All right, everyone. So I just showed you what the capability of borrowing power is with first, second, third tier, and fourth tier lenders. So now let's break it down on the cash flow from sustaining and obtaining these debts, right? So you can see here on the first box here, you'll see major lender, 3 properties at 80% lend, and the loan was 1.2 mil, as I showed you before. Now, right now, I've used a rate of 6%. At the time of doing this recording, it's October 2024. So the rates right now are interest only is around 6.5%. But you know what? We're expecting a rate cut in the next, I don't know, whatever, call it 6 months. So I'm just going to use 6% for now, all right? Interest only structure, repayment's going to be $6,000. That's your rental income per week for 3 properties. That's your monthly rent. And also we've allocated 30% for expenses. And why? Well, that's property management fee, council rates, water rates, insurances, etc. Right? Just as a rule of thumb, your net rent is $5,241.60. So minus that from your $6,000 repayment, you're out of pocket for those 3 properties, borrowing 80%. It's only around $758.40. Okay, for 3 properties, which is not bad. Now, the second box, what we have here is we're going to buy another 2 properties with a major lender, okay, and where we're going to borrow 100% of the purchase price plus cost. And you can see here using 6% again, right? Repayment's going to be a little bit higher because the loan is going to be a little bit higher. There's the rent, etc. And now obtaining 2 properties, borrowing 100% of the purchase price. Now it's going to be $1,705.06 per month out of your own pocket from sustaining 2 properties. Now we're going to go to a second tier lender. The rate's going to be a little bit higher. Remember that, okay? And in this occasion, your out of pocket is going to be $2,398.93. And going down to a third tier lender now, same thing, same debt level, but the rate's going to be higher, okay? Just for these 2 properties, your cash outlay per month is going to be $3,005.60. And if you go down to the bottom of the barrel lender, okay, buying 1 property, borrowing 100% of the purchase price plus cost at 8%, your out of pocket is going to be $1,719.47. Okay, so therefore, your out of pocket for all 10 properties is going to be around $9,588 per month. All right, now, can they afford it? So let's have a look up to here. So what I've got here is I've broken down their net monthly disposable income. Okay, so 2 applicants with $150,000 each, the net income is around $193,324. That's after tax. Monthly, they got around $16,110.33. Now they pay rent and they got living expenses. Obviously, this assume is $4,000. So the fixed overhead per month is around $6,816.65. Okay, that means they've got a net disposable income of $9,293.69, which is a little bit short on the net cash outlay from sustaining the 10 properties by $300. Now, the one thing we didn't take into consideration from these investment properties is, number 1, depreciation. Okay, so obviously you can claim back the depreciation on these assets, right, for the loss in value. So guys, now you know, right? Now you know how much they can borrow at that particular scenario, right? So if you're very similar to them, okay, then that's what you can potentially do, right? But obviously, you know, deposit is a very big factor because they have $360,000 at the back end in the pocket to play around with. You know, if you don't have $360,000 deposit, you might have, call it 120 or 240. You might just have to buy 1 or 2 properties first, right? Then wait for it to grow. Then use the equity, leverage of that property to buy your next investment property. Or you might want to split that, you know, whatever money you have into X amount of dollars and pay LMI on these next investment properties and not put the 20% deposit plus stamp duty on it, right? You just borrow with LMI so you can buy more properties up front, which is not a bad thing, right? Because a lot of people actually do that. You know, I've got clients that only had $200,000 deposit, right? And they want to spread that $200,000 across 3 or 4 properties, right? So it's doable as long as you pay LMI. So obviously, as you saw, you know, to buy a whole 10 properties and getting that amount of debt with that amount of rental income, their shortfall was around $9,500, just under $9,600, which is a little bit higher than the net disposable income, as I just showed you, right? But remember, there's 2 things that I didn't take into account there, right? Well, number 1 is the depreciation on all those assets, right? So the houses, whatever the asset they're going to buy, they're going to lose in value. The house is going to lose in value, right? So they can claim the depreciation back on that. Don't account for that too much because depreciation is a diminishing value, right? So after a certain amount of years, there's not much money to claim back, right? So probably the first 5 years you can claim something back, which will help. Okay, so one thing I didn't bring up, which is the negative gearing portion of it, right? So as you can see on my Excel spreadsheet before, they were just under 9,600 where they're negative geared every month, right? So this will actually give them a big tax refund at the end of the year, right? So whatever the marginal tax rate is, they'll get that money back, okay? Whatever the negative gearing portion is, right? So, but there's something what you call a tax variation, which a lot of accountants don't like to do because it's very hard to calculate, essentially, right? So, instead of paying so much tax up front at each paycheck, you can do a tax variation, you hand it into your work, and you pay less tax back. Therefore, your cash flow is actually better, right? So instead of waiting for the end of the financial year to get all that tax refund back, you can actually just pay less tax up front now and get it all back now, all right? That's the way to actually essentially better your cash flow, okay? As I showed you on the breakdown, these clients can buy 5 properties with a major lender and 2 properties with a second tier lender, right? So when the client starts buying properties under, using your 3rd and 4th bottom of barrel lenders, that's when it gets a bit tricky, bit risky, etc. And the cash flow that I showed you was based on interest only repayments, right? So if you were paying principal and interest repayments, your cash outlay would have been substantially higher. I showed you the repayments based on interest only as a bare minimum, but you can only get interest only terms for call it 5 years only, right? So after that 5 years, it reverts to principal and interest repayments. And if you pay principal and interest repayments on all those loans over a 25-year term, your cash flow is going to get smashed, right? So that's why it's sometimes a little bit risky using 3rd and 4th tier lenders. And that's why when, we have customers using 3rd and bottom of the barrel lenders, there's always going to be a risk involved that we have to tell them, right? Because you already maximize your borrowing power with your major and second tier lenders. If you start using 3rd tier lenders or bottom of the barrel lenders, it's very hard for you to refinance back to a second tier or 3rd tier lender down the track when your interest only term finishes because you're already stretched out. So unless your income increases significantly or unless you've paid down your debt significantly, it's very hard to return and refinance back to those sort of lenders, right? So there's always going to be risk involved. We actually have clients that actually stretch themselves to, with them using Pepper home loans, right? And the interest only terms finish. They actually can't refinance back to a major and second tier lender after their interest only term finish. So they actually start paying principal and interest repayments with Pepper, where the cash flow is actually to the dollar now. They're actually very bad on the cash flow because of all their loans going to P&I repayments. So using Pepper, Latrobe, Liberty is only a short-term solution. Okay, once that short-term solution finishes, you're probably going to feel the pain if you can't refinance that loan back to interest only again. So what we say to most of our clients is when you've maximized yourself with a major lender and you want to borrow more, we sort of want you to stop at a second tier lender because, at least you might have the opportunity to refinance back to a major lender using their 1% buffer refinance rate, or your income might increase that allows you to refinance back to them, to a major lender at interest only again. But honestly, when you start using 3rd tier lenders, you've actually capped yourself quite high. For example, debt to income ratio, major lenders and second tier lenders might be able to get you up to a 5, but with 3rd tier lenders, where if you structure your existing loans correctly, you can actually borrow up to around 8.5 times your income, which is quite high. And those are the risks involved 3rd and 4th tier lenders. So you have to actually watch out, all right? So when we write these plans for our clients, more than likely, right, they go down 2 paths, okay? When we write these sort of plans for our clients, okay, there's 2 paths to go down, right? 90% of the time, these clients will stop borrowing once they reach the maximum borrowing power with a second tier lender, which is what I prefer, because I don't want my clients to get into financial troubles, okay? But we have some clients that want to go a little bit harder, want to borrow the maximum as possible, want to just get it approved at 5 years interest only and worry about it in 5 years' time. We have those clients, and that's probably makes up the other 10% of those clients, right? And look, and some of you more savvy investors out there might be going, do you know what? Well, why don't you just keep borrowing under a trust, right? Yes, you can, but you know what? That's the whole video itself. I don't want to go down that path. And there's actually more tax benefits with purchasing under individual, because when you negative gear, under individual name, you can claim that negative gearing back. But purchase a property under a trust or a company or another entity, whatever you want to call it, all the negative gearing benefit stays within that entity. It doesn't actually get passed on to you individually. So there's no big tax return back at the end of the financial year. So guys, that was just a case study. I want to show you guys and how, certain scenarios, how much an individual can borrow. So guys, I hope you like this video. Please only use this as a guide. It's not financial advice. I just want to give you a basic understanding of in this case scenario. And if you're very similar to these clients, that's what you could potentially do. Okay, so everyone, my calendar link is below. If you want to book a time in, please pick a time for me to call. Let's explore your options. Let's see what we can do for you. You'll be dealing with me directly. I hope you like this video. Give this video a like. Give this channel a follow. I hope you enjoyed this video. And thanks for joining me in another episode of the Mortgage Chat. I hope to see you soon.